Why governments change tax brackets right before inflation is not an accident, not coincidence, and not generosity, but a quiet response to how modern money works and how political systems survive rising prices. Because taxes are written in numbers, but inflation changes what those numbers mean. And when money loses value, laws written in stable terms begin to behave in unstable ways, which creates pressure that governments must manage before voters fully feel it. To understand this, you must first understand that tax brackets are fixed lines drawn in a moving river. A bracket might say that income up to a certain amount is taxed lightly, and income above that amount is taxed more heavily. But when inflation rises, wages rise in name, even if life does not improve. And suddenly, millions of people drift into higher brackets without becoming richer in reality, a process economists call bracket creep, though most citizens never hear the term. They only feel the result when their paycheck grows but their savings shrink and their taxes rise at the same time. Governments know this will happen the moment inflation accelerates, because inflation does not raise prices evenly or gently. It moves through food, housing, fuel, and services in waves, and those waves hit voters before official statistics catch up. When people notice prices rising, they do not immediately understand monetary policy, supply chains, or central banking, but they understand when their money feels weaker, and they understand when the government appears to take more from them during that weakness. This is where tax brackets become political tools. If governments do nothing, inflation quietly increases tax revenue through bracket creep, allowing the state to collect more without passing new tax laws, which is convenient for budgets but dangerous for legitimacy, because people feel squeezed and betrayed even if no law technically changed. If governments act too late, anger builds. If they act too early, revenue projections break. So many governments adjust tax brackets right as inflation begins to rise, not to stop inflation, but to manage how inflation is perceived. These adjustments are framed as fairness, modernization, or protection for workers, but they are also defensive moves designed to prevent inflation from becoming a political crisis before it becomes an economic one. This behavior is deeply tied to how modern states fund themselves. Inflation erodes the real value of debt, which helps governments that owe large sums, but it also erodes trust, which hurts governments that depend on compliance. Tax systems sit between those two forces. By adjusting brackets, governments attempt to soften the visible pain of inflation while still allowing inflation to quietly do its work elsewhere in the system. This balance is delicate. Too much bracket creep feels like theft. Too much adjustment reduces revenue when spending needs are rising. Governments walk this line constantly, especially when inflation is expected but not yet fully visible. History shows this pattern repeating across countries and decades. In the mid-20th century, as inflation became a permanent feature of fiat money systems, governments realized that tax codes written in static numbers could not survive in dynamic price environments without causing unrest. Some countries introduced automatic indexation, tying brackets to consumer price indexes so thresholds rise as prices rise, preserving real tax positions. Others resisted indexation because it removed a powerful fiscal lever. Allowing inflation to push people into higher brackets increases revenue quietly and spreads the cost across society without a visible vote. This is why indexation is often partial, delayed, or politically contested. It limits the state's ability to absorb inflationary pressure through taxation. When inflation begins to rise, governments face immediate fiscal stress. Public wages rise, welfare payments increase, debt servicing costs change, infrastructure becomes more expensive. At the same time, economic growth may slow as central banks raise interest rates to control inflation. That combination threatens budget stability. Adjusting tax brackets becomes a way to signal control while maintaining flexibility. Governments do not announce that inflation will hurt people, they announce that tax brackets will change to protect them. The deeper reality is that inflation is already redistributing wealth beneath the surface. Savers lose, debtors gain, asset owners benefit, wage earners lag. Tax brackets sit in the middle of this redistribution, amplifying it or dampening it depending on how they are adjusted. This is why bracket changes often happen before inflation peaks, not after. Once inflation is fully visible, trust is already damaged. Early adjustments are attempts to shape expectations. If people believe the government is managing inflation, they behave differently, they spend differently, they negotiate wages differently. Inflation is as much psychological as mathematical. Governments know this. Tax policy becomes a tool of expectation management. There's also a quieter reason bracket changes happen early. Inflation statistics are backward-looking. They measure what already happened. Governments, however, have forward-looking data. They see supply pressures, monetary expansion, energy shocks, and wage trends before the public does. By the time inflation is visible to households, governments have already seen it coming. Adjusting brackets early allows them to say later that they acted responsibly, even if inflation still hurts. This preserves credibility. In democratic systems, credibility is currency. Once lost, it is hard to regain, but there is an uncomfortable truth beneath all of this. Inflation itself is a policy environment, not just an outcome. Modern governments operate with high debt levels. Inflation reduces the real burden of that debt. It's politically easier to allow moderate inflation than to raise taxes directly or cut spending. Adjusting tax brackets is part of managing that choice. If brackets are not adjusted, inflation acts like a hidden tax increase. If they are adjusted, inflation still erodes savings, wages, and purchasing power elsewhere. Either way, inflation pays part of the bill. Governments change brackets not to stop inflation, but to control who feels it most and when. This is why tax bracket changes are often uneven. Lower brackets may be adjusted more than higher ones. Deductions may change quietly. Credits may expire. The system is tuned, not rewritten. From the outside, it looks technical. From the inside, it's survival. States cannot allow inflation to expose the fragility of money too clearly, because money is trust. Once trust breaks, systems unravel quickly. History shows that societies tolerate rising prices longer than they tolerate perceived unfairness. Bracket creep feels unfair. Adjustments feel responsive. Even if real purchasing power continues to fall, perception matters. This is why governments act before inflation becomes unbearable. They are not preventing damage. They are managing reaction. Inflation is not simply prices rising. It is a reordering of claims on future value. Tax systems are one of the main tools through which that reordering is made acceptable. When governments change tax brackets right before inflation, they are not fixing the system. They are aligning it with reality just enough to keep it functioning. They are smoothing the visible edges of a process that cannot be stopped easily without larger sacrifice. Inflation reveals that money is not stable. Tax brackets reveal that laws assume it is. Adjustments are the bridge between those truths. This pattern will continue as long as modern economies rely on debt, fiat money, and political legitimacy at the same time. Governments will continue to promise stability while preparing for instability. They will continue to adjust numbers while value shifts underneath them. And most people will continue to feel that something is wrong without being able to name it. That is not because people are ignorant. It is because inflation works quietly, and tax systems are designed to absorb shock before it becomes revolt. That is why tax brackets move before prices explode. Not because governments are generous, but because they understand that once inflation is fully visible, it is already too late to manage trust.